Welcome to the Education of a Financial Planner, where we look at the major concepts in financial planning through the lens of two quant investors who are learning the ropes of the planning process and how to help clients achieve their long-term goals. Learn along with us as experienced financial planner Matt Ziegler helps us understand the most important financial planning concepts that impact all of us and how we can apply them to achieve the best outcomes in our financial lives. In each episode, we will work through one major financial planning concept from the ground up and learn how we can apply it in the real world. From retirement to college savings to taxes to estate planning, we will cover a wide range of topics that apply to each of our everyday lives. We hope you will join us in our learning journey.
Justin Carbonneau and Jack Forehand are principals at Mladina Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Mladina Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Mladina Capital or Sunpoint Investments.
Okay, guys, today we wanted to circle back around and discuss a recent podcast we did with the three of us and Peter Mladina, who is Director of Portfolio Research at Northern Trust. And it was a really sort of in the weeds discussion with Peter, who was awesome. And we encourage people that, listen to this to go over to that episode on the Excess Returns channel. Or is it on this channel? Well, anyways, it's on one of the channels, either Excess Returns or Education.
It's on Excess Returns.
Okay, Excess Returns. So go over there and check it out if you want to kind of learn more about Peter's work and research and his expertise with wealth management, financial planning, goals-based planning, factors, and a whole bunch of other stuff, and just his sort of super knowledgeable thought process on a lot of this stuff. But what we want to do today is maybe come up a level and try to discuss some of these topics, and then also, work through with Matt how he actually uses this stuff in the real world with some of his clients, and I guess what we can all learn from that. So maybe to start, Matt, let's just kind of get into. I know you've been following Peter and his work for some time, and that was you introduced him to us, and that's how we kind of got to know about Peter. But what was the initial sort of draw to some of his work and research?
I got to say this first, too. I know we said, and I would encourage everybody, go to Excess Returns, which is where this episode lives, with Peter Mladina. And also go back to that Meb Faber interview from multiple years ago now, when Meb introduced him to me. I'm pretty sure that's where I first really found his work. I know I'm going to go back and re-listen to our talk with him just the way I went back and listened to that talk with him. And the thing that drew me into his work from the get-go is this idea that I believe good advice is always this balancing act between the logical and the psychological. You can't really tell me what you want to do, or you can tell me what you want to do, like a specific what. But until I know why you want to do it, I really can't tell you how to do it. And good advice, the core of good advice is we know what and we know how, but we need space for that why. I know I'm speaking super philosophically here. What Peter's work does is it takes the what, things like goals-based planning, factors, and all the other stuff, and it actually gives us the framework how, while leaving all of the room for the why, for the advisor or the people giving good advice or whatever to operate on in the middle. And I think that the genius of his work, and I will use that word genius because I think it's brilliant work, it's a real practitioner saying, we're not going to attempt to answer the whys in this literature, but we're going to leave all the room for anybody who understands. If you know what, and here's some ways to do how, once you understand the why, it's the ultimate practitioner's handbook. And that's what drew me into him. And that's what keeps me staying up on his work to this day.
It's so funny because so often when I read academic research, I'm like, well, what do I do with this? So often it doesn't have the connection to what you would actually do in the real world. And that was, I didn't know anything about him until you introduced him to us. And that was one thing that kind of drew me into his work is he operates in the real world. He operates in the academic world. And he's able to kind of bring those together where someone like me who actually manages people's money can learn from his work.
He made that amazing comment in the beginning of the interview or somewhere towards the beginning where he says about how when you're just an academic, you're constantly looking for these problems to solve. But when you're a practitioner, you're constantly surrounded by the problems. So being a practitioner who's also an academic and being a practitioner first, he's exposed to these novel problems in search of solutions. And that really shows in his work because it's all super applicable.
just to get into what he talked about, before we kind of go into everything he discussed, I first want to just introduce this concept of goals-based planning. We have a separate episode people can go to where we talked about this, but I know a lot of his work is around that. So can you just introduce the concept of goals-based planning and maybe what the benefits of that is?
Go hear our discussion for a much deeper look into this. In a nutshell, goals-based planning is saying you have a goal, you have a what that you want to do, save for kids' college, save for retirement, start a charitable foundation, whatever the what is, that's a goal. And what goals-based planning is, okay, how do we get to that goal? How do we save the assets that we have to save to get to that point? And then what do we do on the back end of that? So it's the how once we've defined the what. And again, what Peter's work lets us do is say inside of this goals-based planning framework, we can say, whatever your why is, Mr. or Mrs. Client, that you want to set up the charitable foundation or send your kids to college, like, here's how to do it. A goal specifically is a liability in this sense too, which is college is going to cost this much money. Retirement for 40 years, you're going to need this much money to live on. And it tells us once we have the goal, how to attach numbers to it. And when I say the how, that's really what we're drilling into. We're quantifying these things and we're turning it into an actual process instead of just going like, I wonder how I'm going to pay for those kids to go to school.
Yeah, that was something that kind of drew me into his work a little bit. Is this idea of like aligning your assets with your purpose. And and by the way, correct me if I get anything wrong about his stuff as we go through this, because you obviously know it a lot better than me. But like that was something that I think is very unique in terms of like people who write this kind of stuff. Is you wouldn't see aligning your assets with your purpose like in too many things like that. So can you just talk about like that and what his work, kind of a summary of his work around that area?
I want to say this first, which connects to it, because I always think of this, and I could say this to you guys because you'll appreciate my nonsensical pop culture references. Did you play the game Tecmo Super Bowl specifically on Nintendo in the 90s?
Well, I definitely played that back in the day. I was a big fan.
Who was your team? Did you have a team?
Oh yeah, my team has always been the Jets. That's a whole different episode where we're gonna need some psychiatrists on here to deal with the problems that caused me over the years.
I did once own a Jets starter jacket, circa like 1993, for the record.
I remember those starter jackets. Those were like a huge thing at one point.
They were big. I think I covered the Jets and the Bengals, and I know my brother had a Philly one. I don't know if I had the Eagles one. So in Tecmo Super Bowl, do you remember playing as Bo Jackson or as the Raiders at any point, or getting maimed by someone else playing as the Raiders?
Oh yeah. He was like the best. He was like the best guy in there, wasn't he?
He was, I believe, the best one in the game. If you've never seen the Family Guy clip of Bo Jackson Tecmo Super Bowl, just pause this and go there on the internet because it's delightful. It's so good. So people think a lot of times about, they think about like, they talk about their large cap growth manager like it's Bo Jackson in Tecmo Super Bowl. And they forget that like they're just playing a video game when they're talking about returns and whatever else. And I will connect this back to purpose. So it's this idea that people look at stuff, they look at performance, they look at results, they look at how cool an investment strategy is, and they talk about it like it's not just a video game, but like they found Bo Jackson and they can do all the cool things. And the reality is, like, you're just playing a video game. It might make you cool with your friends for a minute, or it might be fun to beat up on some not even artificial intelligence. I don't even know what you would call the pointlessly diving like bots in the game. But it's this idea of like, you're just playing a video game until you're outside in the real world trying to be the real life Bo Jackson, which probably was pretty friggin' hard. So when we talk about purpose, we're talking about this why. In between the what and the how, we have this thing that we actually want to do. And it's not just to play a video game. It's not just to maximize like returns inside of a spreadsheet and say, well, let's just lever up this beta until we accomplish this thing. It's like, well, yeah. So what? Is it going to be a charitable foundation? Is this to help our kids go to college? Whatever else. If we invest just for the assets and returns, we're just playing a video game. In the real world, where we have to get real results, we have to have a purpose for everything we do. And Peter's work just continuously shines that spotlight back to, you're not just playing a video game here. So why don't you start connecting this to reality and get out of the basement?
By the way, that's one of my favorite parts of our Show Us Your Portfolio episodes is we always kind of ask this question around purpose at the beginning. And like seeing a lot of these guys you respect who have like built these intricate investment strategies, talk about that is really interesting, because they never talk about that. They always talk about the intricate investment strategy. So it's very cool to understand, like, all of us have some sort of purpose, and like, even if we're doing crazy, math to get to what our portfolio is, like, it still has to align with that.
My favorite part about those episodes is exactly that. I love when people kind of like pull back the curtain and they say, it's back to the why, right? I started in this industry, and remind me of his name, the guy who was in real estate and did all the real estate stuff and then basically lost his shirt in like
Jason
2000.
Buck.
Jason
It was
Buck.
Jason Buck, right? Okay.
Yep.
So like Jason Buck goes through this kind of traumatic why for a brief period of time, like he was Bo Jackson's agent almost, and everything was rocking and rolling. And then the world handed him the financial crisis. And it's amazing how, like, in the core of these strategies, you see that why manifested in all these other ways. And he can still talk about all the intricacies and all the amazing math that they do, but poetry when he starts explaining it to you, like, where it comes from.
Before I switch to my next thing, I know our listeners want to hear more about Tecmo Bowl, so I just want to tell you, like, my daughter has a Nintendo Switch, and you actually can go back now and like play all those old games. It has like an emulator. So like I've been going like playing Super Mario Brothers and like all that stuff. It's actually very cool. Like brings me back to like my childhood doing all that stuff.
There is nothing better than having an emulator to play those games. And I mean, we're covering the classics on this series. I just want to also point out we've definitely talked Mike Tyson's Punch Out. Now we've got a good Tecmo Bowl riff. If you want to assemble the shorts of this at some point, we'll cover
your
all the
challenge is
Nintendo
Legend
classics.
of Zelda for the next episode. So
okay,
make it work.
Game on.
Before we move off of this, though, I don't know if we were going to move to the next thing, but I think it's interesting to think about. You have, like, I'm trying to think when you actually try to implement this for a client, right? You have a client with assets, they have certain goals and purposes, and it would almost seem like to truly implement it, it's like I would envision like a sheet, because I would think most people's goals, whether it's retirement, saving for their kids' college, maybe being able to, when you retire, take a big trip once a year, or maybe do something special with your family, or maybe leave money to charity. Like I almost envision like a map or a sheet with like 20 different goals, and then mapping the assets that you have to those goals, and then kind of adjusting maybe annually to see, have we met the goal? Are we on track to meet the goal? But what's, I think, difficult with that is I think of my own investment accounts, and it's just like a hodgepodge of holdings. And so it's almost like you need to peel those out, and then you need to map those to those goals. And that's kind of it's quite a daunting task when you think about it.
This is where a financial planner or a lot of financial planning software candidly can do some of this work. Ashwin Chabra, we definitely have to get him for one of these Peter Mladina style conversations, because he's instrumental in some of the ways that the industry illustrates this, which is goal funding status with preferences on top of this. So you might have your various accounts scattered around and everything else, but then how do you actually say, here is my list of goals, here's my list of their priorities. I don't want to fail on retirement, but it's okay if I come up a little short on the kids for school because I can borrow for that, whatever those scenarios are. And you can check in at each point in time, whether it's once a year when you review your stuff with your advisor or your planner or whatever, and say, what's my goal funding status for these things? And then shift the risk down in parts of the portfolio as things become completely funded. So there are frameworks for this. At Sunpoint, we actually have like a separate presentation. It's kind of like a deck that we build. So after we do all the modeling and the fancy spreadsheets and calculators and the various tools we use, we assemble it together in a narrative format, following along that calendar, cash flow, balance sheet model, that whole way of thinking, to say like, here's the points in the time, here's the stuff that needs to get converted into cash flows, here's which accounts are going to fund these different things, or which accounts we're going to spend into for different things. And it can be done. It can be done. Mm-hmm. You got to work with somebody, though, who's building those maps. And frequently, I think a lot of people aren't in the habit or the practice of building those maps to show to people.
Yeah, as Justin mentioned at the beginning, we had originally intended to do the interview with Peter for this podcast, and we ended up putting on excess returns. And, the reason we did that is because we all have the tendency to want to get in the weeds. And once we started doing that, we have a hard time stopping. And so the point of the episode where I knew we were going to be doing that was when we started talking about the intertemporal capital asset pricing model. Because to be honest, I don't even know what that is. So it could be very complex. So I'm wondering if maybe you can, like, at a high level, explain what that is, and maybe more importantly, how it relates to what we've been talking about.
Okay. First off, I don't believe for a second that you don't know what that is. So I'm calling your bluff on this.
Well, then maybe I don't know it in full.
You know what would you please kindly, without going in, you don't have to read the Wikipedia page or rewrite it, like the capital asset pricing model, what is it and why does it matter to somebody building a portfolio?
Yeah, so I mean the capital asset pricing model, which by the way has been completely invalidated, but the theory of it actually makes sense.
Details. It's the Bo Jackson of financial models, really.
Yeah, and to explain it in really simple terms, the idea is like my return should be some function of like the risk I'm actually taking. In the capital asset pricing model, they have this idea of beta as a measure of risk, and we found since then that beta is not a good measure of risk. But yeah, like my return should be some function of like a risk-free rate plus whatever risk I'm actually taking. That's maybe the simplest way I would try to explain it.
Yeah, and it's a way we can also explain approximately what like we can take the unit of return per unit of risk, right? It helps us explain those things.
Right.
What ICAPM adds is it adds the temporal element. So just riff your way through that. Why does adding time to this calculation matter as we think of return per unit of risk?
I guess because everybody has a different time frame they're dealing with.
No, that's exactly it. Everybody has a different time frame, and every goal or objective or thing we're investing for, every purpose has a different time frame tied to it. So when we talk ICAPM, and the reason that was for me as a practitioner, when he explained ICAPM against the goals-based framework, that was my light bulb moment, because now it was all the stuff we would do when we were investing for private pensions or pensions and things like that, where we could turn around and just say, oh, like your kid's college is really like it's like a pension that needs to exist for the 4 years they're in school and we have to pay that off. And now we can think about unit of risk taken for potential unit of return in terms of I need to pay for school for this 4-year period. How do I get there? So ICAPM takes all that math, invalidated or not, adds a time element to it, which is the way we connect it from just being about return maximizing. And now we turn it into goal maximizing.
So how does that work in terms of the actual like formula? I mean, we don't want to get into detailed formulas here, but like in general, like, so are we considering our risk-free rate, is not just the short-term rate? Our risk-free rate can be a longer-term rate. I mean, is that the way we're thinking about it?
So before you get me back into my 4th grade fractions and math trauma, we'll put it this way. So yes, so like looking at the risk-free rate for the goal in the future or for the period of time, you can actually start to stack your risk model on top of what you're doing. So if you're planning for something over like 30 years, your risk-free rate might be like the 30-year rate and whatever else is in your calculation. If you're trying to do something over a very short period of time, you could think there. In the old pension math days, this would be the difference too between, can I solve this with a quote unquote risk-free treasury portfolio? Do I have to add corporate bonds to the mix? Do I need a little peppering of high yield for some flavor to get that return just up to the line I need it? Do I have to go full CalPERS and have levered private equity to get there? That's the math.
Yeah, one thing you don't see a lot, or you probably do in your world, but like with some more basic financial planning, you don't see this idea of human capital coming in that much. Like, whatever I'm going to make for the rest of my career actually has some value, and it probably should be considered, when I'm building a financial plan. So can you just talk about that idea and maybe Peter's work around it?
Peter's got some of the best starting work around this, and one of my personal takeaways that I was most excited about from that interview is that he said this needs to be explored more. I love hearing somebody like him saying this needs to be explored more, because either him or somebody else, hopefully as smart, is going to dive into this work. Human capital, from his work, the way he explains it is almost to think about your job, your career, your arc as an asset itself. Now, correct me if I'm wrong, but I'm pretty sure, Jack, you are compensated for some of the work you do. I know you're making millions and millions off of this podcast.
Yeah, exactly. I'm usually on my yacht, so I usually don't even know what I'm making, but it's obviously an incredible, massive amount.
Clearly. So you're not a hunk of gold And I'm sure you guys know, like, what's the way that Warren Buffett puts it about, like, whenever somebody asks him about the value of gold?
I don't even know that.
It's something about like it has no cash flows, so he can't value it.
Oh yeah,
Well,
that's right. Yeah, I do remember that now.
So Jack, you in Buffett's eyes are worth more than a hunk of gold because we can value the cash flows of you sitting on your yacht collecting your massive passive income stream, right?
Yeah. Well, I'll say that. I'll say Buffett thinks I'm worth more than gold, which I can go with that.
Can we make some excess return mugs that say Buffett thinks
worth
I'm more than gold
or something?
Yeah, I'm more than gold. Everybody could have one on their desk. So this idea that you and your career are an asset, so any investments in your human capital or your human capital potential, and I know we covered this in some of the podcasts too, and talking about your career and thinking about early stages in your career, how you invest in yourself and things like that. We can then take that and think of it like, is my career, is it a bond? Is it a treasury? Is it a corporate bond? Is it a high yield bond? Is it like equity where it's super, super variable? I'm not getting paid anything, but if I do this right, there's this giant payoff on the other end. And kind of the brilliant thing that connects it is when I say glide path, really curious. If I say glide path or target date fund, what's that mean to you?
Yeah, it just means I'm changing my asset allocation over time as I kind of age. I think that's a simple way to put it.
That's a fantastic way to put it. And a lot of times we'll see these now as default options inside of retirement plans like 401ks, where people are like, oh, I think I'll retire in 2040. So I'm going to have the 2040 target date fund, which is basically just lowering my equity allocations as I get closer to that date. Now, the reason you do that and the reason that it's interesting is if my career is like a bond, then as my job is diminished in its role as like throwing off income in my portfolio, I need then a financial asset. I need a bond in my portfolio to make up the room that my job, my human capital has left behind. Does that make sense? Like, did you follow that connection between human capital and investment capital on the glide path?
Yeah, no, that makes a lot of sense. And, and I think it's really important because, going back to my millions and millions of dollars I'm bringing in here, my millions and millions of dollars is a stock more than it's a bond. Because like I work for myself, I have a company, like it could be zero. So I think it is kind of important for everybody to look at that. Like where someone who has a corporate job that's really, really secure, is much more of a bond and I'm more of a stock. So it's important to sort of look at that, I think, in your total financial picture as to what it is. And then also, like, to your point, it's got to be replaced eventually when it goes away.
In my own work that I do with clients, a huge part of it is because I work with a lot of business owners or entrepreneurially minded people. And so with them, understanding how they reinvest in their human capital and just being able to say, like, somebody has a business, it's a few years in, it's doing well, and they're trying to figure out how to save for themselves, but also reinvest in the business. And you have to have conversations like, is another $10,000 or $20,000 into the 401k worth the same as $10,000 or $20,000 into the business at this point, understanding the arc of what you're building, the equity in your business, whatever else. This is kind of the formula for how we help think about that. And Mladina's work helps lay the groundwork for what that is. There's still not a lot of solutions around this. I want to add one more level to this, and I'll throw one more pop culture reference. And we do have to get Justin Castelli on one of these. I know we said that before. He and I had this conversation sort of relating like families or groups of people to Wu-Tang, because that makes sense, right?
There's a lot of people in Wu-Tang, I know.
Yeah, so here's the other side of human capital is we're not just investing in ourselves, but we're investing in the people around us. So just as an example, Jack, you're married to some like a multi-billionaire heiress or something like that, clearly, right?
Obviously.
Yeah, obviously. So as we think about the people around us, well, they might be, if I have a super risky job, I might be like in equity, but if my wife is a nurse or something, she might be like a corporate bond. And so as we think about these combinations of people, we get into this other mix too, and how we invest in our networks of people. This is why networking is so important. So what Justin and I were talking about was like this Wu-Tang thing where it's like everybody has to be a standalone investment on their own, but then you have various outcomes and various ways that these can spin out over time. And if you're really smart about curating and setting up the opportunities for who does a solo album versus who does a posse cut, you can really change the ultimate net human capital, as Peter Mladina would say, that produces the cash flows that turn into assets on your balance sheet over time and then can provide for futures, goals, gifts, consumptions, whatever.
I don't want to go into too much detail about the second half of the episode, because that's when I really probably got in the weeds way too much when we switched to factor investing. But I'm just wondering, like, if you think about his work on factor investing, I'm just wondering, how does it relate to maybe what we're talking about here? Like, in terms of people's goals and purposes. I mean, can you tie those two together?
Yeah, so I think this is the whole too, that he was saying more work needs to be done on. But I think this is where behavioral finance, when correctly applied, what I said at the opening of the episode, good advice is always logical and psychological. No way to split them apart. When we talk about factors and we talk about portfolio construction, we are talking about the logic of deconstructing returns. But we're really talking about, why do factors exist? We're really usually talking about some philosophical basing. We're talking about this idea that there's this psychological thing that's there, like value investing works because people are selling something at a faster rate than what it's actually worth until they overreact. And it's that overreaction to bad news that creates the value premium. Just like the momentum premium exists because it's an underreaction to positive news, right?
Right.
So we can connect all these behavioral ideas in the CAPM framework, where once we interject time, and once we aren't just talking about investment capital, but we're talking about human capital, we not only can better explain our own behavior and the why behind people and their goals-based plans and what they're trying to achieve, but then also the investment strategies that align back to those people. The whole purpose, or a huge purpose of these conversations, is you got to do something you can stick to. And suffice it to say, Wu-Tang Financial, great and delightful joke, but like the best investments like the RZA ever made was probably like in those friends, in his buddies, in his cousins, in the people in that group. That probably did better than any private investment he ever made inside of order and magnitude. And we can take all those factors and we can use those to basically deconstruct to the level that somebody wants to. I don't have to come out and say what's Jack's value factor or what's the appropriate beta for Jack's life on his yacht. But what we can say is what's Jack predisposed to? How's he think? How's he operate? How do we get Jack and his family where they want to go through this lens of understanding the behavioral side, the psychological, as much as the logical how to get there?
Yeah, there were a couple other things I kind of took that I think are more basic from that second half. And one is this idea that, now that we've discovered value and now that we've discovered momentum and these other things, like creating alpha is much harder because ultimately, if I'm just the plain vanilla value fund, that before in the past, back in Warren Buffett's day, would be alpha because, we hadn't really discovered the value factor. But now I can buy the plain vanilla value fund for almost nothing. That's not alpha anymore. That's like beta. And so I that to me is interesting. I mean, maybe those terms are a little complex, but the idea is, it's much, much harder. Like some of these basic factors that are out there now, it's very easy to get inexpensive exposures to them. So as a manager, I got to do better than that now. I can't just have the basic value thing and take my price to book or whatever. I've got to do better than that to add value.
How do you think about moving that into privates or things that are harder to access, like smaller corners of the market where it's not everybody knows small cap value is the thing per se, so that's what makes it extra hard right now. But not everybody can do what we would view as traditional value plays, but expressed in, private real estate or private credit or something. How do you think about that as a
Yeah, well, I think
builder?
there's the opportunity, the opportunity should be there to have more alpha there. Because obviously going back to what I said about the ability to access that stuff inexpensively, as you move down, obviously the ability up at the Apple and the biggest companies, you can easily access that in the large cap space. But as you move down, even to the really small cap space of the public markets, you can maybe generate a little more alpha there. I mean, less people can operate in there. It's less crowded. There's less volume. So and as you get to privates, I'm assuming it's even more so that. So and I think Mobison is the one who came on our podcast and talked about this. You have to you got to play in areas where others are not. To some degree. And the more people competing in any given area, and the more sophisticated they are, the harder it is. You want to try to find things in your life and investing where you can maybe have an edge, where there's not tons and tons of people competing against you.
So we
That
just
whole-
we just did a show us your portfolio with Larry Swedroe from Buckingham yesterday, and what was interesting was, and he was really transparent with how he's invested. But to your point, Matt, he thinks that going into these more illiquid places, and he gave examples, and he actually gave firms that are packaging up these in terms of products. But he's a big believer
he
in
wrote
these
a
alternatives.
great private credit paper. I don't know, less than a year ago, I think. That was
Yeah, no, exactly. That's exactly how he's kind of getting exposure to these less, and he's giving examples of like if you can get it in like a beta form, you might get like 7%, but like he's targeting like 10 or 11% with some of these things. Anyway, so that's a good point, I think.
And the crazy thing with Larry is you can put he wrote a great and put anything in the blank after that paper.
Yeah.
And you can pretty much fill in anything. Like there's really no topic in investing like Larry has not written a great paper about.
Well,
No,
it was like
he's a guy.
every question we asked, he's like, yeah, and my book about this, and my book about the incredible shrinking alpha, and my book about factors, and it was like he's written a lot. Yeah.
Swedroe, Mladina, Mobison, like those guys are all like on some Mount Rushmore stuff with understanding this. And I think, and this is, I'm staking the next 10 years of my own personal career on this. I think understanding the same ways we understand the privates on the investment side, I think are the same ways we understand private investments and investing in ourselves on the human side. And I think that crossover between applying like everything the Swedroes and the Mobisons of the world have told us about public markets to say, now let's apply that to other things and then apply them back to ourselves. I think it's all right there. And I think it's infinitely interesting for how we better ourselves, our careers, and our portfolios for the things we want to do.
Yeah, I agree with you. There's just one more thing I want to mention from the end of the episode. One of the biggest lessons I think I got, and I already knew this, but it's always good to drive it home, is this idea. We talked about this idea of how difficult it is to pick managers, like, or how difficult it is to find people who are going to like outperform for you over time. And like, it's hard for institutions to do it, but and I think he kind of corrected me when I said this. I said it's like hard for institutions to do it. It's even harder for people. And I think he kind of said like neither one of them can do it. It doesn't really, it doesn't really matter. But that was another takeaway for me is like we all have to keep in mind when we're trying to like select outperforming managers how daunting a task that is. How much we're up against when we try to do that.
Yeah, and it's not worth the damn if it's not mapped back to you. Because if you're going to take the risk, you got to be able to shoulder the risk and understand the risk you're taking. Otherwise, you risk being horribly disappointed. And that's as true as it is when he says it's really hard for institutionals and investors to do it, as it is in our annuity episode when we talked about why do steak dinners get people to do silly things. It's because there's a logical and a psychological aspect to advice. And if somebody leans too hard on something where you don't actually understand the logic or you've been taken advantage of for your psychology, you're going to be really disappointed in something. And if that's the thing that leads to you not able to reach a goal or pay for something you wanted to be able to pay for or accomplish something in life, you got to be able to understand it. And it's really friggin' hard. So know what swings you're going to take and why.
Yeah, and that's something I've never done in my career. Like if I'm picking an active manager, like I've never thought about like tying that back to like what my goal is or what my purpose is. And I think that's probably pretty important because it puts it in context. Like, all right, I'm picking this random active manager, but what am I actually trying to accomplish? And like, how does that get me to where I want to go more so than some other, index option or whatever else is out there? Like I've never really thought about it that way. You're just like, let's get the best return possible. But it's tying those two things together is really interesting to me.
Without the purpose side of it and without the time component, I think if the average investor, quote unquote, takes anything away from Peter Mladina's work or our talk trying to dissect some of these really rigorous, really analytical arguments that he makes, is just that. If before you make an investment or think about something, you tack it back to purpose and time. So if you're saying like, where does this fall on my calendar? How does it influence these cash flows? Either what I'm saving out of or pulling money from to pay for this thing from my balance sheet, from or to my balance sheet, then that aspect, what's the purpose? What's the time frame? Why am I doing this? And why am I comfortable with taking this risk? The grossly oversimplified version, back to the glide path idea, I'm taking this equity risk away from my net human capital. I worked at my job. I saved this money out of my paycheck. I put it into a stock fund in my 401k. I'm not going to retire for 20 years. That logic, that Mad Lib, gets applied over and over and over again. If I have 5 years, I might be looking at some gap between like, small cap and large cap stocks right now and be like, well, that's kind of broken. I don't need this money for at least 5 years. Like maybe I can bet on that gap closing, and here's a way for an active manager to help me do that. That's a very different way of thinking than either just throw it all in Vanguard or I'm going to go day trade some insane stock strategy because it makes my ego happy today.
Is there anything else we missed in terms of like his work or in terms of the episode that do you think we should cover?
I mean, the biggest thing we missed was that Scramblin' Randall Cunningham is really the underrated star of Tecmo Super Bowl.
He was really good. I remember that.
Very injury prone. It was really hard to run him the whole season because he was totally going to get hurt like your last game of the season and then miss your playoffs and blow your Super Bowl.
Remember, he also kind of changed football, like in terms of the running quarterbacks and stuff. Like he was one of the original running quarterbacks, who could kind of do everything. Like that's a huge thing today, but it wasn't as huge a thing back then.
He was the rare exception, and his running stats, again, despite his injury factor in that game, made him like he was an extreme threat. If you weren't getting rushed to be able to do this. So I would say we definitely just need to acknowledge and salute Scramblin' Randall for his many years of service to us Philadelphia folk. But Mladina's work I don't want to say it gets buried in the academic thing if you're not reading the Journal of Finance and all the other stuff where it shows up. But practitioners like you guys talking about Swedrow, talking about Mobison, talking about stuff like what Mladina's writing and the depth of this factor work, it actually makes us better at what we do. And I think it's really important, just like you would expect your doctor to be reading the medical journals, your financial professionals and the people you work with, this stuff is always getting updated. Look at that point you made about like the CAPM and how we understand it differently now. The thinking keeps evolving, and it's on professionals to keep evolving with that information and trying to take better care of people who are doing it. I love the idea that you brought up, like you hadn't really thought about putting your time horizon against your investments before in that way. We learned something from this.
Yeah. And Matt, I think you did an excellent job just a few minutes ago, kind of summing up, I think, what the key takeaways are. So I think I'll just close with thanking you for giving us exposure to Peter's work and for, helping us sort of digest all this and understand it and think about how it's being used in the real world. So we hope you guys enjoyed this episode. If you want to learn more about Peter, you can go to Northern Trust and read his research, or you can listen to our most recent podcast with him. So thank you guys for watching. Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau and follow Matt on Twitter at @CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.